Hello, and thank you for joining us today. My name is Timothy Lee, and I'm a research analyst at Red Cloud Securities, and I'm delighted to host a Red Cloud webinar on gold and copper exploration and development today. We will hear from Marshall Koval, President and CEO, and Scott Hicks, VP Corporate Development and Communications of Lumina Gold. During today's webinar, they will provide an overview and outlook, and then we will take questions. You can type your questions into the chat box at any time, and we will get to as many as we can. Before we kick things off, first we need to discuss some fine print during this Lumina Gold webinar. Forward-looking statements may be made. I would direct listeners to the company's forward-looking statements disclosure outlined on page 2 of the Lumina corporate presentation, and that can be found on the company's website, luminagold.com. For Red Cloud Securities, Inc., I would highlight that this webinar is for information purposes only. It should not be considered a solicitation or a recommendation to buy or sell securities. We note that this call does not consider the particular situation or needs of individual investors. Participants should rely on their own investigation and seek their own professional advice before investing. Please see our most recent research located on the Red Cloud website for specific disclosures pertaining to Lumina. So we have Lumina Gold presenting today. The company is part of the Lumina Group, which has an experienced management team with a strong track record of developing projects and companies and strong financial backing led by Ross Beatty. And it is focused on advancing its Cangrejos project in Ecuador, which hosts one of the largest undeveloped gold-copper deposits globally. The company has recently reported some important milestones in advancing the project, which they will no doubt tell us more about. With that, I now turn it over to Marshall and Scott to update our audience on the company.
Yeah, thanks, Tim, and thanks to all of the Red Cloud listeners. Let me just go high level a little bit here and then have Scott come in and go through the deck a little bit. We, as Tim mentioned, it's one of the largest gold and copper deposits globally, primarily gold. It's sort of an 80-20 split gold to copper. We did a PFS in 2023, and we had 11.6 million ounces of gold and 1.4 billion pounds of copper in reserves in the probable category. We've gone and started a feasibility study, and we're well advanced on the feasibility study as we speak. We've completed all the field work, drilling programs for metallurgy, for updating the reserve, for geotechnical pit slope development, mine design, and then facility siting. So that's well advanced, and we're in the feasibility engineering and costing stage now. And we anticipate having the feasibility study complete at the end of the second quarter of 2025. So we're well advanced there. And in parallel with that, we've started the environmental impact statement work or study work. And we're in the field working on that as we speak. So that's a process that'll take sort of probably on the order of about 18 months to complete. And that's off and running. And then Scott, I'll have him talk a little bit about some of the deals that we've done with the government as far as royalty, investment protection agreements, term sheets for an exploitation contract that talks about what the royalty range that we'll have to pay. So things are moving in a good way. I think, Scott, with that, I'll sort of turn it over to you to start into the deck, and we'll kind of go back and forth here.
Yeah, thanks, Marshall. Sounds good. So yeah, thanks everybody for tuning in. It's obviously been an interesting year in the gold space. I mean, we've seen gold go up, let's call it, $700-800 an ounce here. We did start the year with our stock around probably 35 cents. So happier to be at 50 cents today than 35. But, it's still been a tough market for the juniors. And obviously, we think we're still pretty undervalued given what we have on the books here. So let's talk about some of the recent news, because I know a lot of you guys have followed this for a while and have seen this deck before. So we just signed our royalty agreement with the government of Ecuador for the exploitation contract, and we're pretty happy with how this shook out. So, for those of you who may not follow, Ecuador is close as we do, basically there's an NSR royalty for all mining projects there. So Lundin Gold pays a flat 5%, Mirador pays 5 to 8%, depending on the copper price. But in 2018, they moved the scale, and it's now a 3 to 8% progressive royalty. So SolGold did their deal last year with the government in kind of mid 23. We were negotiating ours basically around the August-September timeline this year. And we were focused on a couple things. We were focused on getting the royalty prepayment, that top line you see here, down so that we didn't have to raise more upfront capital as part of the CapEx for the project. So we were successful in that. So we negotiated a $25 million royalty prepayment. And basically the way that works is we owe $2.5 million next year when we sign the full exploitation contract, and then $7.5 million once we start construction, and then $7.5 million a year later, and $7.5 million a year after that. So basically over a 2-year period. So that was kind of the first big win, I'd say, in contrast to what SolGold negotiated with the government. They were at $75 million. The other thing, obviously, is we were very focused on, getting higher metal price thresholds for both gold and copper, which are basically 99% of our revenue, to have lower royalties in the current commodity environment. So we were able to get our 3% scale up to $2,225 an ounce versus SolGold at $1,400 an ounce. So that was a big win. And we were also able to increase the thresholds by $250 an ounce instead of $200 an ounce. So in today's commodity price environment, we'd be paying about a 5% NSR on gold, sitting around $2,700 today. Copper sitting around 4%, so we pay a 3% NSR on copper. So, at today's spot prices, we're actually paying a lower royalty than a weighted royalty, say, than Lundin Gold or than Mirador, and certainly much lower than SolGold, who'd be 8% on gold right now and about 6% on copper. So, I'm not sure if the market understood kind of the nuances in comparing this against all the projects in Ecuador, but we were very happy with these results of the negotiations. And I think it takes a lot of risk away from the project, obviously knowing how much money's going to the government. So that was kind of the recent news that we wanted to highlight today. And we're happy to answer some questions on that on the back end of this presentation and kind of the next steps of the agreements with the government. The other thing I wanted to flag for people here on this call, and this is a slide we wouldn't usually have in the deck, but I wanted to talk about it. I mean, we are seeing M&A pick up. I saw actually O3 Mining got taken out this morning by Agnico as well. We've seen a lot of Canadian and Australian M&A. But just to give you a sense of the value disconnect that we're seeing in the market right now, if you looked at, say, Osisko's Windfall project here in Canada or Hemi in Australia that's owned by De Grey, these have both been taken out for multiple $1 billion at very high multiples, 1 to 1.2 times PNAV, over $200 an ounce in the ground. And, to reference, Lumina's traded at 0.1 times PNAV right now, and with about $6 an ounce in the ground valuation. So, I appreciate Ecuador is going to have a discount to Australia or Canada. By no means am I suggesting that, they should be exactly the same. But, when you're talking about a 10x multiple difference between feasibility stage assets that are getting taken out versus where we're trading, I think that's very interesting for investors. And, if you look at some of the project metrics here, whether it's reserves or mine life, production, or just the scale of the NPV of the project, I think Cangrejos stands up very well to all of these projects on a global basis. So I'd encourage people to dig in on that a little bit, do your work. I think you'll find that this is one of the cheapest, if not the cheapest, gold development story that's out there right now. So maybe just kind of flipping to where we sit in the market today and our cash balance and some of those things. At 50 cents, we're trading at about just over $200 million Canadian market cap today.
Yeah, so we've been in Ecuador since 2014 with the Correa government. We started then. He had shut mining down in 2009, realized he needed direct foreign investment from other sources than oil, had budgeted $100 oil, and oil had really tailed off. So he opened the mining sector back up, but it had a bit of a regulatory and fiscal regime like oil sector. So what we've seen is the industry working with that government improved the fiscal regime and regulatory regime. And then there's been 3 successive governments since then. And each government went from a far left populist to a center left to center right to another center right. Today, each government has improved the fiscal and regulatory regime for mining. And mining is becoming much more of an important aspect of the economy of Ecuador. It passed bananas in March this year and became the 3rd largest exporter in all sectors. So what we've seen with the Noboa government, who is in office until May of next year, elections will start in February. He's still running ahead. And then the other top candidate is from Correa's party, Luisa Gonzalez. And they're running about 30, Luis is around 30% in the polls, and President Noboa is about 35 to 40%. Either one of those become the president next year. We'll see continued improvements and support for the mining sector. One of the challenges that has happened, and I see a question on the screen already, is this energy crisis that they've had in Ecuador. So over 85% of the power in Ecuador is hydropower. Ecuador is just coming out of a 60-year drought cycle where they had blackouts in the country to preserve energy. President Noboa just announced yesterday that the blackouts will discontinue. They're starting to get rain and starting to get power back. So hopefully in the longer term, they'll be able to stay ahead of that. They're looking at alternative energy sources and both, wind, solar, and natural gas, those sort of things. So I think it'll continue to be an important issue going forward. They're also in the process of interconnecting the Ecuadorian grid with Peru. That'll probably happen over the next 2 or 3 years. There's concession bids out now for that. And they already are interconnected with Colombia. So Colombia was experiencing a lot of the same drought conditions, but they've improved. So more power is coming in from Colombia as well. So I think in the longer term, that's going to kind of sort itself out. So beyond that, the other issue in the country has been security, and Noboa's done a good job dealing with cartels, illegal mining, that sort of thing. So I think there's a high probability that he'll get reelected. He's a young guy. He's, I think, 37, 38 years old. really wants to see the country develop. He's U.S. educated in sort of political science and economics. So I think we'll see him get reelected is sort of what it looks like now, but that's kind of where the sector is.
Yeah, and then on top of that, I mean, this pipeline of projects, they're all kind of moving forward. Silver Corp's building Curipamba that you see there, and they announced a lot of progress next year on Condor, which was our old project in Luminex. Cascabel's moving ahead full steam on feasibility study. So and Warrenza, which isn't on here, has begun permitting, but they haven't put out an economic study yet. So I mean, there's a big pipeline of large projects, and we continue to see the sector get smarter there. We actually hosted it was about a 250 person event just on tailings in Quito 2 weeks ago now, and that was very successful. So the interest in mining and the professionals are really coming into the country.
Yeah, good point.
This is just kind of a case study on obviously the most successful, and there's not a lot of operating mines in Ecuador and the only ones in a public company, but just an example here of how it can be done. Lundin Gold is now about an $8 billion Canadian market cap company. They had Fruta del Norte, which will produce they're producing about 500,000 ounces a year right now, which is pretty similar to what Cangrejos will produce on a gold equivalent basis. You can kind of see back in 2016, 2017, they were doing the steps that we're doing now, finishing the feasibility study, getting the agreements in place with the government. And obviously, as they de-risked it and put it into production, we've seen tremendous success from them. So it's just an example of what can happen when things go right. And, there's definitely an Ecuador discount for the developers, but, Lundin trades at a phenomenal valuation. So there is a path to get out of that. And we think we're doing those steps right now. So just as a refresher for people, specifically where we are in Ecuador, Southwest Ecuador on the coast, right by Puerto Bolivar, where Mirador is shipping their copper concentrate out of. This area is, low elevation. It's got lots of water for the operation. We've got a power substation about 20 kilometers away that they're currently expanding, putting more transformers in. They're also looking at putting, solar projects adjacent to that, looking at putting more hydro in and around the area. So, to Marshall's comment on the power situation, people are actively working to add more capacity there. We've got no communities on the deposit. So basically the nearest community is about 7 kilometers away. It's about 600 people in that community. They're very supportive. We hire most of our workforce out of there and have lots of ongoing community programs. But, we think this is probably the best infrastructure setup for a large porphyry in the Andes that you'll see out there. So, we've talked about the scale of this project. It's very large. It's the 13th largest undeveloped primary gold deposit in the world. If you include copper on an equivalency basis, I think it's the 10th, basically on an EQ basis. It's lower grade, but we think of this more like a copper porphyry, and we see copper mines getting developed all over the world at these type of grades with this scale and production capacity. So we think it's a very doable project. The things that help us and drive our low costs are really the low strip ratio, 1.3 to 1 at the mine, so we're not moving a lot of waste. We think we can get that even lower in the feasibility study. As much as power has been a topical issue, the rates are still very reasonable in Ecuador, so it's around 7 cents a kilowatt hour. We've got the infrastructure I mentioned there, and then really economies of scale. So just using very large scale equipment and really helping to drive those mining costs down on a per ton basis. The CapEx for the PFS was about $1 billion. We're rescoping the front end. We'll talk about that in a sec, but it'll probably go up a little bit because we're going to start larger. How advanced is the project? So that exploitation investment protection contract term negotiations I was mentioning, that was a big tick. So having that done is huge. The next big step for us is the feasibility study in Q2 next year. And then, as Marshall mentioned, the permits, which, earliest would be kind of end of Q4 or early 26. Earliest would be end of 2025 or early 26 as we go into next year. The deposits themselves, it's two large adjacent open pits. We'll start mining at Cangrejos, which is the larger and higher grade of the two. And then we'll move to Gran Bestia to finish out the mine life. Currently, we're thinking, Cangrejos is about, call it 13 to 15 years of mine life. And then, the rest of the mine life will come from Gran Bestia to get up to that kind of around 26-year mine life that we had in the PFS. We've planned this thing pretty conservatively. So if you look at the blue outline there of the two pits, that's the 20 million ounce resource. The red pits on the inside of that line, that's basically the reserve mine plan. So we've taken about 12 million ounces of the 20 into reserve. We've planned these pits at around $1,100 gold as the constraint for them, and then used a declining NSR cutoff inside the pits to optimize them. So, we think this is a conservative mine plan. All our holes ended in mineralization, and it's still totally open to the northwest. So there's definitely potential for an operator to expand the mine life just by going a bit deeper or by drilling out to the northwest. So we think there's lots of upside here. The drilling that we mentioned completing on this slide, about half of that was for infill, so to upgrade the resource confidence from probable to proven, and the other half was for a new round of met work and geotech drilling to determine the steepness of the pits. So we think we'd be able to optimize some of that stuff. Just skip by that. So the two products here are really a copper gold con, which will have about 78% of the gold recovery in it, and a doré, which will have the other 7%. So we're looking at about 85% gold recoveries, 79% copper recoveries, and that kind of gets you that 80-20 gold copper mix we mentioned at the start. There's a little bit of silver, but not too much. It's about 1% of the revenue. And we'll have new numbers out on this with the feasibility study and integrating the latest met test work. So just on the PFS numbers, and we've gone through some of these. The things I point out is the life of mine capital. We do expect to change that. So this shows you the capital to go up to 30 on the initial, and then 60,000 tons a day, 80,000 tons a day eventually. The fees is going to be 40,000 to 80,000 tons a day. So we'll bring forward some ounces. It'll be a little bit more capital, but we think it'll be a higher return and a higher NPV on the project. And then in the bottom right, you can kind of see the torque you're getting in metal prices there. So for every 10% your basic move in metal prices, you're basically adding 600 million US of NPV, again against our $200 million Canadian market cap. So you can see at that 1980 level with 450 copper, we'd be at $3.5 billion US NPV. The costs in the top right, so very competitive. Q1 T-green on Q2 cost profile there, $870 an ounce on a co-product basis. We're net of the copper, $670 an ounce gold. So this is quite good. Things that help here are the strip ratio we talked about, low diesel prices in Ecuador, low power prices in Ecuador, and the access to infrastructure. So just talking about the Wheaton stream quickly. So basically, we've received almost all the money that was due to us now for the early deposits. So we've received 37 million in cash payments to use on the feasibility study and drill work and G&A, and about $8 million as well for specific purchases of infrastructure that we need for the project. We could draw another 3.1 million on that as we buy specific things. But basically, this is pretty close to all drawn. And then as the second portion of the stream here, there'll be $250 million that goes towards construction. So of that $1 billion of capital for the PFS, this covers about a quarter of it. It'll be a little bit less than that percentage-wise of the fees capital number. What does it do to the NPV? It drops the NPV by about 10% in the base case. It actually increases the IRR because you're putting up less capital to get the mine built. So, Wheaton's a great partner. They've been very flexible, and we think they'll continue to be a great partner going forward for either us or whoever builds this mine. Marshall, do you want to talk about kind of some of the changes we're looking at infrastructure-wise and how this all comes together?
Yeah, so basically what you're looking at on this slide is the two pits. There's primary crusher in kind of magenta color there, waste rock storage facility below, and then conveying over to a process plant, and then to the west of there going down to a dry stack tailings facility. What we've done to kind of tweak this a bit in the feasibility study is we'll mine the Cangrejos pit sort of year 13 through 15, then mine Gran Bestia. We'll use the Cangrejos pit to backfill Gran Bestia waste, and we'll have a smaller waste rock storage facility footprint than you see on this figure. We've also moved the process plant from the upper left-hand corner to the area in between the Gran Bestia and Cangrejos pit. So it's much closer to the two pits. And then we'll have a pipeline down to a dry stack tailings facility. We'll recycle about 85% of the water back to the plant. The tailings will be in a sort of a flatter, lower elevation area with less rainfall. So that's kind of the plan. Now, the biggest change is in the PFS was 30,000 tons per day initial throughput for the plant, and in year 3 going to 60,000, then to 80. We've simplified that, and we have basically the same flow sheet as the PFS, but we're going to start at 40,000 tons per day and then go to 80,000 tons per day in year 5. Go ahead.
I was just saying, this is the dry stack facility Marshall was referencing off to the west. So this holds all the material from the tailings and certainly has lots of room for expansion going forward.
And beyond the water benefit of the dry stack is you've got, you don't have an impounded dam with water behind it. It's more like a landfill type structure where you have a stability shell on the outside, and then you have this 15% moisture content max material behind it. So it's quite a bit better from a progressive reclamation perspective, and then also stability is if there's any sort of failure, there's not much of a run out at all. So we're seeing a lot of the industry heading towards dry stack tailings facilities, and a lot of advances have been made where in the filtration process, larger and larger filter plants and lower operating costs for these. So it's kind of the way a lot of the industry is headed into the future.
Yeah, and I see there was a question here on closure. So Marshall kind of touched on it there, but you're progressively reclamating both the tailings facility and the waste rock storage facility at the project as you go. And then the pits will be left to fill in with water. And the nice thing is, based on all our test work over the last decade, neither the waste rock or the tailings is acid generating. So that's a big plus for the project. So just on timeline for the project. So, feasibility study and permits are obviously the key gating items here. Obviously our kind of stated business plan over the years has been to sell the project, but if we do have to build it, you would look to get a financing package together in 2026, and it would be about a 2.5-year build to build the project. So talking kind of, call it late 28, probably into 29 to start production for the project. So just a bit of benchmarking here. I think as you look at these projects, you can see that Cangrejos is kind of in the right part of this curve of all the projects that can produce over 250,000 ounces a year. There's about 34 active projects that can do that right now in the world. 4 of them are getting finished or just got finished: Cote, Solaris Norte, Greenstone, and Blackwater. The ones in the yellow and Cangrejos are held by independents, so not a lot of these. And we put the gold only on here, but as I say, once you add the copper, we bump up a couple spots at least on this graph. So we think this is a project that delivers the right scale with the right amount of capex. And then just touching on the strip ratio a little more specifically and the grade. So if you look at a lot of these open pit milling peers in the gold space, we beat towards the bottom of the set or at the bottom of the set here on grade. But when you adjust for the strip ratio, we go to the 3rd best in the set. So this really speaks to mining costs, not moving a lot of waste to get at that ore. It's pretty important. I mean, a lot of these projects in Ontario, they're getting built right now are finished. They're around or just above 1 gram per ton, but they've got 4 or 5 to 1 strip ratios. So it's moving a lot of material to get at it. And we think that's one of the best advantages Cangrejos has going for it. And if you talk to the copper guys, this is really how they think. They think in on an adjusted strip ratio basis. So maybe the last slide I'll touch on, and then we can take some questions. Just to kind of point this out to people again. If you went back to 2017, we had a 4 million ounce resource at the project, no economic studies. Since then, we've done 3 studies de-risking the project substantially. We're pretty close to having the 4th study being the feasibility done. We've put in a lot of money. I mean, obviously, you guys saw the call it $45 million from Wheaton US. I mean, that's all been invested in the last year and a half. Market cap today is down about 1% versus where it was in 2017 versus gold, up 120, copper up 50. And the resource up 400%. So, I mean, we think this is wildly undervalued right now, and everybody should be taking a look at this as we get closer to production. And maybe with that, Tim, we'll hand it over and answer some of these questions I see in the chat here.
Great. Thank you very much, Marshall and Scott, for the informative presentation. And as Scott mentioned, we'll now start the Q&A portion of the webinar. A reminder to everyone on the line, you can type your questions into the chat box at any time. We have a few questions here, so we'll get started. Kind of circling back, you did mention the energy situation in Ecuador, and we did have a question along those lines. How are you affected by the current energy crisis in the country? And what are the long-term infrastructure and cost implications?
So the current energy situation in the country, we've had minor blackouts up at the camp, but we've been able to continue to operate there. I think the bigger question there, and I think there was an auto generator question. So part of the agreement that we signed with the binding terms of the exploitation contract, the government is got the government's power system, but there's also private power providers within the country. So basically what the agreement says is we retain our right for access to the regulated power grid or power system, but we also should pursue private power, whether auto generating has a large sort of meaning to it, whether we invest ourselves or we get a concession with somebody that, or we get power from somebody, private parties that have a concession in the country. So we're talking to several of those sort of companies. We've got some initial term sheets and we're working on that. So I think in the longer term, I think once the 60-year drought kind of subsides and things move back to normal, that'll take pressure off of the overall power situation. And I think there's more and more power that'll be coming from Colombia as well. And Peru's got a massive surplus of power. And once the Ecuadorian grid and the Peruvian grid are interconnected, that'll make a big difference. And then also once that happens, there's the ability to get power generation contract transborder into Peru. So we think right in the short term here, the power situation is a bit challenging. I think in the longer term, it'll work itself out. And it's obviously one of the main focuses of us at the moment.
Yeah, and I see there was a question around, or part of that question was capital as well. So, I mean, if we're willing to sign a 30-year PPA with a provider, we're not necessarily on the hook to put up that capital to build the project. There's third-party power companies, as Marshall said, that would fund that with the certainty of us using their power for 30 years, right? So that's kind of mechanically some of the things we're looking at.
And we did just have another question, maybe continuing on that topic. As what is your position on the elimination of electricity subsidies for mining companies in Ecuador?
Well, what's happened here with the regulated power was about mid 6 cents a kilowatt hour. With this situation that they had recently, that power went up about 30%. For that, the project that was affected the most, that I understand, it was Mirador. Fruta is moved towards getting its own power, which it should have here pretty quickly. But I think in the longer term, what we've seen going into the private sector is very competitive power prices that are sort of in line with what we're seeing, the 7-cent power range that was before the 30% hike. So I think, it's kind of an evolving thing, but we think that there's quite a few concessions that primarily hydro, but also solar and not so much wind, but we're seeing those sort of prices.
We did kind of shifting to the environmental side. One question here, please talk about the baseline water quality testing and future plans to mitigate any potential water quality impacts. Do you anticipate any significant costs associated with acid rock drainage from the waste rock pile?
No.
Yeah, no, I mean, we've had humidity cells going on the property for years and years with material. So there's enough neutralizing properties in the rock. So no.
Okay. And one question here, obviously you had mentioned, you'd potentially build it yourself, but initially the plan was to sell. So certainly major players have looked at this, and I believe the deal was close around 2020 when COVID hit. Do they just want to see a feasibility study, or are there concerns about grade or capex?
Scott, let me start, and then you can kind of hop in here. If you look at the broader development sector, and I'll give you an example. We've had to take development projects further and further and de-risk them before transactions have happened. I think if you look right now at Artemis, I mean, they've gone all the way into production, or their construction and close to production, and they're a likely takeout target at some point. So we had to see further and further de-risking in the development sector before these transactions have happened. And I'm on the board of Equinox Gold, and it's a little bit different scenario, but we had 60% of greenstone, and Orion had 40% of greenstone. And we got through construction, and we're just getting ready to start commissioning, and we bought the 40% share of Orion. So people are looking at things getting de-risked further. Scott, I don't know what you want to add on top of that.
No, I mean, I think that's right. The number one feedback we got in 2020 is it's too far from production, right? So, I think now post-feasibility study, somebody's got line of sight on, it potentially being shovel ready in 12 months, right? From when the feasibility is finished. So I think that addresses that. And obviously, I mean, there's a lot of work between a PEA and a feasibility study. And I think people, certainly the feedback I've heard has been, the work to date has been excellent, whether it's the geology, the resource modeling, or the engineering work that's gone into it and the thought. So, those are the sort of things that are very hard to convey to the market, but, pay off in the long term.
And one question looking ahead, obviously, is I guess what exploration potential do you still see on the project? And there's a question: are there any plans for further exploration for resource expansion after the start of operation?
Yeah, for sure. There's that opportunity. Scott had a slide earlier that he talked about Gran Bestia being open to the north and northwest, and also at depth. Cangrejos is open a bit to the southwest, and then beyond that, and it's also at depth, open at depth. But beyond that, there's other exploration targets that we've done work on that we haven't drilled into a resource category. We got to the point where between Gran Bestia and Cangrejos, it was a large enough project that we weren't adding much to the story with the drill bit. So there's two really highly prospective areas just to the north of Gran Bestia, one called Valorizo, and the other one is Pan de Azúcar. And both those areas look to be high up in the system, where you have a complete porphyry system below them. And we've done a lot of surface work, and we have soil anomalies and, sort of drill ready targets there. So obviously, once you move towards production, you would start to do work in those areas.
Okay, great. And one question, always popular, and perhaps specifically in this situation, we had just recently gotten a payment from the streaming deal. How much cash do you have currently, and how far will that get you with your current plans?
Yeah, so shade over 11 million US on the balance sheet, and that gets us through the feasibility study and pretty well into 2025 there.
Okay.
And then, yeah, I mean, if the follow on to that is, if it really depends on your approach at that point, whether, you want to do detailed engineering and get that going, whether you want to, acquire more infrastructure space. So there's a variety of things you can do if you're going down the path of building it that would ramp up the spend, or you can kind of pull back a little bit and evaluate selling the assets. So that's kind of mid 2025 board level decisions.
Okay. We do have a question, and maybe I would even ask a follow-up to this, but about what volume of concentrate would this produce? Do you already have an estimate for the expected average gold content in the concentrate as well?
Yeah, let me answer the grade. So we've targeted sort of 15% copper to 18% copper, and that's most of what you're seeing in the concentrate. And the gold grade varies between 60 grams per ton to over 200 grams per ton, depending on where you're at in the mine plan. Scott, do you remember how many dry metric tons per year we're looking at producing?
It's about 100,000, call it, if you want to use a round number.
Yeah.
Okay. So.
And there's a bit of silver in it as well, and it's a really clean concentrate. There's no arsenic, antimony, mercury penalties, fluorine, or anything like that. And then on top of the concentrate, we're also going to produce a doré. So about 7% in the pre-feasibility study of the gold produced would be a doré from a CIL circuit, where you would take the coarse fraction of the rougher tails and you'd run it through the CIL, and then the cleaner scavenger tails would go through the CIL plant.
Okay, great.
Yeah, and not that it was a big cost in the PFS model, but obviously what we've seen in the TCRC space, so the refinement and treatment costs for concentrate, I mean, they've dropped 80% since we did the PFS basically. So there's it's a pretty big advantage and demand for concentrate right now. So 100,000 tons is not a lot in the global concentrate market. And we think our con is going to be very desirable for blending because it's quite clean, as Marshall said. Great. So we're as part of the feasibility, we've got a marketing study going on right now. So they're going out to all the smelters, and we've produced concentrate out of our MET program in Lima this year with pilot plants. So we have samples of that.
Okay, great. And then one final question, maybe kind of a closer here. Overall, looking forward at key steps. Obviously, you mentioned in the presentation. We do have a question here. If the EIS will be done in 18 months, I guess when would you anticipate final permits? And maybe hand in hand with that, kind of summarize a little bit of key steps here coming up.
Yeah, so the 18-month reference I made would be all the way to the environmental license through the EIS process. And in parallel with that, you'd have other permits that you would have to do. And part of those would be run in parallel. So we would look at the entire sort of permitting process at about 18 months.
Okay, great. Great. Well, I think that's all the questions we have today. I would like to thank Marshall Koval and Scott Hicks for presenting today. And thank you everyone on the line for tuning in. We wish you a happy holiday season, and Red Cloud's webinar series will continue in the new year. Have a great rest of your day and happy investing.